Okay, so we are continuing on page 8 of chapter, oh God, I don't know what chapter I'm in, 2. And now we're going to do the opposite. We're going to switch from the equity method to fair value through profit or loss. So this is very nicely taken from the CPA handbook. Oh, there's an extra C in here. So that's where you get the wording from. And basically you're going to recognize gains or losses from selling part of your investment. Okay, so that's all it says. When you switch methods in net income, so not OCI, you've got to record the value of any retained investment and any proceeds from disposing part of the interest in the associate and the carrying amount of the investment at the date when significant influence is lost. So you also have to recognize amounts in OCI separately as if the associate had directly disposed of it. That's not too critical. I'll go through a typical example for this level, and hopefully it'll make sense. Okay, so Ford owns 25% of Rule Co. And if I didn't say this, what would we assume they'd been using if that's all the information we gave you? They're using the equity method, right? Because it's greater than 20. No amounts had been retained in OI. That's important. If there is, you have to separate them. So the balance of the investment at December 31st, year 7, after closing entries, is $460,000. Is that fair value, this $460,000? No, because what method have we been using? The equity method. So this is not fair value. On January 1st, year 8, Ford sells 10% of the shares in Rule for $190,000. Shares are trading at $190 per share on that date. So what have they just done? They've reduced their investment by how much? 25 minus 10, they've only got 15% left. So what do they have to use then? Fair value through profit or loss, they told you in the title. On an exam or on a question, they'd either say OCI or profit or loss. Usually I stick with the profit or loss. Okay, shares are trading at 190 per share on that date. What does that tell us? So how many shares were there? $190,000 divided by 190 gives us 1,000 shares. And that's equal to 10%. Everybody good? Now, on December 31st, year 8, shares are trading for $200 per share. So what do we have to do at the end? Well, what method are we using now? Fair value, so we have to write to fair value. Okay, so this one I've thrown a little couple twists in for you to, well, not so much twists, but different ways to think about it. Some little pieces of information are missing, so you got to fill it in, do that kind of stuff. Okay, so let's start. January 1st. So here we've got the balance of the investment is 460. It's not fair value. And January 1st, Ford sells 10% of the shares in Rule. So let's draw Ford's little investment first. Okay, what are we starting with in here? Well, the first thing they tell us, the balance is 460. And we know it's not fair value. Okay. So, let's start doing the entry and piece it together. So, January 1st, year 8, what happens? We sell shares. So, how much cash do we get for the shares? 190. Now, how much do we have to take out here of the investment? Are these the price as these were? Not likely. So we've got to figure out how much we have to take of the investment. Now you guys did this in 316, hopefully it'll come back. We need to figure out what percent of this 460,000 we're selling. So what percent are we selling? Is it just 10% of it? Well, what does this whole thing represent? Well, whole percentage. 25%, right? And how much are we selling? 10. So we are selling 10 over 25. Remember, this isn't 100%. We don't own 100% of the company. We only own 25%. And what we're selling is 10%. So 10 over 25 times 460,000 equals 184,000. So that's right there. Remember, we're using the weighted average cost as if they all cost the same, and so you take the total and then you take the percentage you're selling. Okay, so we know that's 184. But we're out by $6,000. Credit. So, what's that going to be? Remember, we have to recognize gains and losses if you sell part of the investment, so this is going to be a gain on sale. Okay, and let's balance, keep going as we go. So what method are we now using? Fair value. So let's figure out what entries we have to do at year end. Well, what's happened during the year? Rule declared net income. Do we record that? What method are we using now? Fair value, so no net income. So net income, don't use fair value through profit or loss method now. Everybody good? Okay, no dividends. I'm just going to fill them in here just so we remember about them. So debit dividends, no. Cash or some kind of receivable, and credit dividend income okay, everybody good with that? Do we do mark to fair value? Okay. So we've got to figure out what the value is now. So let's say value now, $200 per share. Okay. Well, what does that tell us? Do we know how many shares are left? Well, we said 10% of shares was, we set it up here, 1,000 shares. Right? And if 10% is 1,000 shares, what does he have left? 15%. X shares. So you can just cross multiply and solve for it. Guys, you've done that a gazillion times. You can also think of it reasonably. If 10% is 1,000 shares, what's 5%? Well, 500 shares. So if we add 500 shares onto 1,000, did we get 50? Yeah. So think of it however you want. So, what should the value be then? It should be 1,500 times 200, which is 300,000. So, going back up to our little chart, our T account, we want it to be 300,000. So that is the fair value December 1st, year 8. So, tell how much it went up? Yeah. We have to write it to 300,000. And that fill in the blank is 24. So, are we debiting or crediting the investment? Debit the investment for 24,000. And what do we credit if we're using fair value through profit and loss? Unrealized gain for 24,000 also. So, I hope that makes sense, guys. They'll throw little things in throughout, and it'll keep increasing till you're working on cases at the CPA, and you'll have to make different assumptions and things like that. So kind of get used to it. If you let it sink in your head for a little while, slowly you'll come back and go, okay, I see what she did. And then the more you do questions with these little pieces of information left out or not straightforward, you'll be able to do it more and more. Okay, on page 9, we've now finished fair value through profit and loss to equity and backwards. So the last little sections I just want to draw your attention to. Read about that. Oh, and that's in the equity method. I just stopped writing for some reason. Acquisition cost, that's something we're going to talk in the next few chapters. Let's say you have too many losses and all of a sudden your investment account's getting to a credit balance. Basically, you record a liability based on legal or constructive obligations. Legal being stuff written in the law. Constructive means it's expected. And presentation and disclosures, also good to read. The closer you get to the CPA, the more attention you should pay to it, because they do pay a lot of attention to it. Okay, so here's the problems. There's a nice little video walkthrough on one problem. Self-study problems are good. For the rest of the course, both in problems and on exams, assume that IFRS is being used unless it is stated otherwise. Okay? Okay, so that was chapter 2. I hope it made some sense, and we'll see you in chapter 3.